Welcome to CEO Connect, presented by CU Solutions Group. On this month's episode, helping your members save and invest through wealth management services.
Credit unions face more competition than ever before, but unlike past decades, the real threats don't seem to be from other depository institutions anymore. In every sector of credit union product offerings, new competitors are using new business models to get to consumers quicker and in more targeted ways. In the May 2019 edition of the Harvard Business Review, the feature article was titled "The Age of Continuous Connection." And the basic premise was that new technologies have made 24/7 customer relationships possible, and that it's time to change business models accordingly for all businesses, including financial institutions. This seems especially true for credit unions. I recently came across a chart that lays out basic financial needs from a consumer's perspective. There are three categories. We need to pay someone, there are times when we need more money, and we want to protect our surplus. Credit unions seem to do very well in the first two categories, but they struggle sometimes to compete in the third. And with many larger credit unions low on liquidity, this category of helping members save and invest seems to be a big challenge more than ever. Lining these categories up with credit union product offerings helps to understand current and future competition and how credit unions need to respond, in my opinion. Obviously, the traditional areas of payments include checking accounts, credit and debit cards, and ACH transfers. In the new competitive world, it's P2P money transfers via Venmo or Zelle, for instance, as well as bill pay services through mobile banking offerings. When it comes to the need for money, the traditional areas that credit unions focus on are mortgages, credit cards, lines of credit, and secured loans for autos, boats, RVs, and so on. But in the new competitive landscape, members are bombarded with offers from Quicken Loans, from large credit card issuers. Retailers, including Amazon and now even Apple, have their own affinity credit cards. Point-of-purchase financing for those big-ticket purchases, and even payday lenders for the quick short-term loans. In the third category of protecting our nest egg or our surplus, the traditional competition used to be other banks' CD rates and savings accounts. But lower interest rates for the last few decades, really, and the evolution of investment platforms and new neobanks reloadable debit cards. The competition for savings dollars and investable funds is fierce with the likes of E-Trade, Acorns, Green Dot, and other new players. And as the current 10-year economic expansion continues this year, it will become the longest economic expansion without a recession in U.S. history later in 2019. And credit unions' balance sheets are much, much different than they were coming out of the last recession ending in 2009. According to the 2018 year-end call report data, U.S. credit unions' loan-to-savings ratio stood at 86%, and credit unions with over $1 billion in assets were at 90%, with many at a ratio well over 100%. Most credit union leaders understand that the critical product relationship with members is the checking account tied to a debit card for the first category of banking, paying someone. But in today's environment, the huge wealth management companies like E-Trade and Ameritrade and others have their own checking accounts that easily sweep money between investments and the checking account. And in the case of disruptors like Chime and Green Dot and other neobanks or challenger banks, simple multi-feature reloadable debit cards are offering millennials especially and others a fast, easy alternative to traditional checking accounts. So in today's economic cycle, most credit unions may need to focus more effectively on the two categories of payments relevance and wealth management, as opposed to lending. This cycle will surely change as we near the next inevitable recession, but for now the race is on to retain and grow transaction accounts, CDs to fuel loan growth, and relatedly helping members with the protection of their nest egg or savings and investments. Going back to the Harvard Business Review article, I think of my own experience with my credit union and with what I perceive to be the case for many credit unions, frankly. That is, I wonder why credit unions don't more effectively sell their products in these areas that I'm mentioning. I am like many other consumers who maintain multiple relationships with financial services providers. I tend to use my credit union for checking and debit card and for the occasional auto or boat loan and for my mortgage refinancing or home acquisition and home mortgage. I'm courted to affinity credit cards for travel rewards, and I use E-Trade for its easy-to-use investment services. And of course, I use insurance companies for home, auto, and life insurance. But my very excellent credit union is not unlike what I believe to be the norm for other credit unions. They know that they have me for the checking and debit relationship and for the occasional loan, but they don't really attempt to sell me on their wealth management services or their savings and investment products. And yet I know that the credit union is 80% or more loaned out. And many of their members, like me, are prime targets for some of those savings and investment dollars. Now, the Harvard Business Review article suggests that there are 4 basic, what they call connected strategies, that businesses of all types should use in this age of so-called continuous connection. They are, number 1, respond to desire, 2, curate offerings, 3, coach behavior, and 4, automatic execution. Most credit unions operate in the first category. They do some advertising, but they really wait for the member to come to them based on a perceived service need that the member will have from time to time. They then try to be fast and efficient in the processes and hope that the member is knowledgeable about what they are looking for. And this works best when members want to control their data and be in control of the transaction. The HBR article, though, suggests that the disruptors are better at getting to the latter 3 categories that start with customized or curated offers, making good personal recommendations to targeted members, to those who don't mind giving up a little bit of data to receive such customized offers. I started thinking about this and I realized that I am among many existing credit members who would actually like it if I got an email or a text or even a phone call from my credit union to let me know why I should save more with them or use their savings or investment services. Or even better, I would welcome an unsolicited, customized pitch for how my savings and investment needs could be better met, at least partially, by my credit union. Of course, the holy grail in any service industry is to get to the category of coaching behavior or even automatic execution, where based on a data-driven understanding of member needs, the credit union is able to nudge the member toward a product or service and even enable self-service through great web, mobile, or call center channels. Competing in this new hyper-mobile world of financial services will require that credit unions have high-quality, mobile-first offerings. But they also need to get better at selling their services to members who may only be using them in 1 or 2 of the 3 categories that I mentioned. This will require better data strategies, but in reality, it can start with a simple commitment to a better targeted sales culture that shows members that the credit union has the right products and truly wants the member's business, especially in the categories of payments and wealth management.